Welcome to the What to Watch video update. Every week after I do all the other videos, the last video that I do is I pick out those charts that are really speaking right now, and I come up with a list, those things that are looking positive, and then those things that are looking negative. I have some intraday charts, a lot of daily charts, and even some very long-term charts to go through. This is being prepared for Monday, July 8th. Before I get started on that, please know that I do have a thing called the SPX investing program. It launched in the early part of June. It's currently free for right now. There is a link not only on the YouTube channel, but in the description below this video and every video that I post that will take you to the SPX investing website. There's also a link if you want to learn more about the program. There is a playlist on YouTube that you can follow through. There are also videos available on Rumble to learn more about the program. If you have any questions or you want to contact me, here's an email address. We can have a back and forth that way. And just to set something up, possibly, maybe by chatting or doing an actual video conference with each other, just to see if this is something that interests you. Also know that this What to Watch video is only one video that I do each week. I also do a weekly video. I do an intermarket analysis video. I do a deep dive video. I also do supplemental videos. There's a few that are on the YouTube and Rumble channels. But in the program, I'm going to start keeping the supplemental videos only accessible to members. But the reason why I do a lot of different videos, my personal approach to analyzing the market that I've done for decades is we want to find out what's going on a day-by-day basis. That's why the daily video is in the center of this graphic here. All the other videos that I do, including this one, are supplemental videos. Ultimately, it comes down to just checking out the market day by day by day. We can see things before they happen. We can anticipate changes in the market and then see them actually unfold or actually stop starting to happen. And that gives us some really good insight. Over the years, I've found that intraday, that's too much. There's too much noise by looking at within the day itself. Weekly charts, that's too long. I found that the Goldilocks approach for me, according to my analysis and the strategies that I teach and I implement, comes down to the daily video. So if you're coming across this video, please be aware that there are other videos that I post each week. The first area that I'm going to look at are all the positive things. And we have a pretty long list right now. You can't set all-time highs for the S&P 500 and not have a few things that are positive. First of all, looking at sentiment. Now, a week ago when I did this chart, we were negative. We're not really moving around all that much. We're not going up or down with any real conviction. The reason why this has switched back over to positive is we crossed back above 50. Now, we're still neutral when we scale this out, but the fact that we're showing a little bit of an improvement as the S&P has been going up, that is positive. When we really notice this chart is when we get up around or above the 75 level. That means we're getting a little too happy about things, or we drop below 25. That means things are becoming a little too negative. But right now, we're pretty much neutral, but slanted more towards the positive side. Here's a daily chart, and this is looking really good too. We're coming up, setting new all-time highs with the S&P. We're above this 50-period moving average. We're above this trend line. The one warning sign to be aware of is you see this dashed line right here. This is a pivot point, and these are calculated well before we even see that based on time or price. We came right up to that, and that was the high that we set on Friday. Sometimes these pivot points, when we're going up, will act as overhead resistance. What we want to do is break through that and continue to go higher. This sometimes will act as resistance and cause us to fall back. Another thing that's positive, which maybe is a little too positive right now, is I measure the standard deviations either above or below the midpoint to see, are we going up really fast? Are we going down really fast? Right now, we're coming up into the +3 channel. We're even at the high end of that. That means that we've been going up pretty far, pretty fast. Now, in context, we were chopping sideways for quite a while, and then we finally broke out this past week. And so we're not really moving all that much before we get more of an extreme positive reading, we can stay up here for a while. You can see a number of days, even when we were really moving up, we can stay into this +3 channel for a while. But when we get to this, excuse me, when we get to this level, that just means that just to be aware of that. We're also looking at a Bollinger Band chart here, and this doesn't happen very often. And what's even more rare, I don't have the chart here, but we closed above the upper Bollinger Band here on the daily chart. I don't have the weekly chart. We also closed above the upper Bollinger Band on the weekly chart, and that is even more rare. If you go back and look, there's not very many times that we stay above the upper Bollinger Band for very long. Now, that doesn't mean we're going to reverse and go in the other direction. It just means that maybe we're going to slow down. It might need to take some time to see the Bollinger Band actually catch up. And the percent B, which measures when we're above or below the upper or lower band, this may tend to drop back. Now, we could still go higher than this. You see, we've had other higher readings, but when we get up to this level, this is just where we want to take note of this, even though it is positive. Then I have a thing called the boom indicator. And this measures how far away is price either above or below a 20, 50, and 200 period moving average. And then the reason why this is called a boom indicator is once we get far away, we have a tendency to go, it's like a rubber band. We get so far away and then boom, we head back towards the moving average. Well, when we look at the 20 and the 50, we're getting a little far away. Now we could still go higher than this, suggesting good momentum. But when we get up into these extreme areas, we just want to make note of that. We're still looking fairly positive here when we look at the distance away from the 200 period moving average. Looking at our trend, and this is more intermediate term based, and this is a real foundation of my personal technical analysis. It's the average directional movement known as the ADX. We are in a positive trend right now. The ADX itself is this black line, and that's going up, and it's above 20. So that suggests that the trend is getting stronger. I also put a moving average on here, and when we're above the moving average, that's more dynamic, and that also shows that we're showing a strengthening trend. We have the green line on top, and that's going up, so that's also positive, and the red line is going down. So in the intermediate term, we're still looking quite positive here. The one concern that we may have is if we continue to go up, if we start to go above 40 with either the ADX itself or the green line, that may start to look extreme positive. Where we're seeing a little bit of a concern here is this is an experimental ADX chart. It's more short term. And we're already above 40 with the ADX, and the moving average is also above 40. The green line's going up, so we're positive. But when we get above this level, this is just when we want to be aware of this. It means that we may be getting overextended to the upside. We also keep an eye on the VIX. This is the fear gauge. When the VIX is going up, that means there's a lot of fear. When the VIX is going down, there's not much fear. We did tick up a bit in Friday's session, but overall, we're getting very low readings on a closing basis with the VIX. Also, with the bar chart, we're below these moving averages, and the moving averages are going down. And this suggests there's not a lot of fear in the market. We also look at the VIX of the VIX, or the VVIX. This just measures how is the VIX actually moving. When it's going up, this has a tendency to go down. We did tick up a little bit on Friday because the VIX actually went up. Where we put this all together is Tom Bowley did some research, and these numbers actually were as of October 2023, but the chart itself is updated after Friday's close. When we see that the VIX is very low and we're under 13 now, we closed at 12.48. That's when we see the best annualized returns. That's when the market really does the best. If we get up above 13, up to about 17, we still see really good returns, but they drop off quite a bit from when the VIX is lower. If we get up about 17 to 20, we still see positive returns, but they really drop off. They're about half of what they were when the VIX is a little bit lower. When we start to turn negative is when the VIX shoots above 20, and that's when we see negative annualized returns. We're coming in with very low readings right now, which is positive for the market. We also keep an eye on the direction and the momentum of the VIX. It looked like we were starting to go back up as measured by the MACD, and then we were coming down. Well, now it's starting to roll back up as we had that up day, even though stocks were up in Friday's session. And then these are the active asset managers. These are professional money managers. You might have one of these folks that you hire to manage your money on your behalf, and they're human beings and they have emotions. Well, they're getting a little too positive right now. And they come out with a report every week. Now, sometimes this can lag, but when we get above this 90% level here, and we're actually above 100 right now, this is when we start to look extreme positive. Now, this could still go up further than where we're at right now, and it doesn't necessarily mean doom and gloom. You see other times when we had really extreme readings, and it might just denote some kind of sideways action. It doesn't really mean that we're going to reverse necessarily. It just means that maybe the optimism is getting a little too extreme at this time. Here's an internal measure of the S&P 500. There's a negative side and a positive side to this chart. The negative side is we're setting all-time highs with the S&P. We're not even setting breaking above this previous high when we look at the advanced decline line based on price. That's the negative side. We want to see price matching up with what is happening above with the S&P itself. Where we're looking more positive is volume. We held up, even though the S&P was going sideways. This is breaking out and looking a little bit more positive. So we're seeing that negative divergence based on price, but we're seeing confirmation based on volume. Also looking at the new highs and the new lows, this is another internal measure. We do see a lot more new highs than new lows, but when we look at our 5-week, it's kind of right on top of its moving average, and the 10-week is declining. That's not that we're seeing an expansion in new lows. It's seeing more of a contraction of the new highs lately. We want to see this doing better than it is, even though it's positive right now. The S&P is setting all-time highs. We want to see this green line continue to go up, this histogram here, and see the moving averages turn and go up. Just a little bit of a warning sign as we're seeing just a small group of stocks actually really influencing the S&P 500 as well as the NASDAQ 100. This is a little more negative. This is the advanced decline ratio. The blue line is short term based on 19 periods. The red line is more intermediate term based on 39 periods. We're dropping below zero right now. Now, even though the S&P has been going up and setting all-time highs, this going down, that's a bit of a negative divergence. Now, we could get that back if we see more broad participation within the S&P itself, but for right now, it's showing us a negative divergence. Then accumulation distribution, and I added something to this recently. This is a smart money indicator. This measures not only the direction of price, but where's the volume going in this indicator. And when we're above this red line here, that means that we're looking quite positive. Now, down below, the boom indicator that measured how far away we are from a moving average, I set that up to see how far away is the indicator away from this moving average, and we're starting to get to an extreme reading. Now, it doesn't mean we have to stop here. Doesn't mean we're going to reverse. It just means we might slow down, but we could still continue to go up with this reading further. There's a positive side and a negative side with this particular chart as well. This is another breakout of the 19-day advanced decline ratio. We're dropping below zero based on price, but we're still above zero based on volume. The chicken money flow, another smart money indicator. It's positive, but we're not really showing a lot of improvement here. We want to see this green histogram go back up, and we want to see the red line turning up too. So it is positive, but not showing us an awful lot of strength currently. The chicken oscillator, this is looking more positive. We're above zero and advancing. And then we look intraday. This is growth, which is in blue, and value, which is in red. The blue line is above the red line, even though they're on different scales. And this is just showing that on an intraday basis, growth is outperforming. And that's more positive for the S&P. Here's a ratio between growth and value for the S&P, and this is continuing to go up. And this is looking quite positive for right now. But then when we look at the small caps, a little bit of a tick up here, but not really a breakout, as the small caps have really just been range bound for all of 2024. Seeing a little bit of an improvement with the mid cap growth to value ratio, but nothing suggesting all that much strength. Where we're seeing more of an improvement is S&P growth to value. This is an end of day chart. We're breaking out above these previous highs, and for right now, this is looking quite positive. We look at a growth ETF and a value ETF and do a ratio. The growth ETF is outperforming the value ETF. Coming back, we're getting a little close to these previous highs set back in 2021. We're wondering if that can continue. This is another disappointing area, even though it's positive. Discretionary has just been bouncing along sideways. This includes things like Amazon and Tesla. And Tesla's been a big drain on this particular sector. And it's not that the discretionary is doing all that great. It's that we've been seeing some recent weakness with the staples. So when we look at this ratio between the two, this is holding up and it's positive, but not really giving us any real conviction right now. We look at some other growth to value ratios. The Qs are looking a lot better when compared to the S&P, and both are doing quite well right now. Discretionary is showing a little bit of improvement to the S&P, but we're still hoping to see if this moving average will turn up and start to go higher. We're looking better here when we look at large cap growth versus large cap value. So with the large caps, we're looking okay. A little bit of an improvement with the mid caps and the small caps, but not really showing any real strength there. We look at a double and triple exponential moving average based on 20 periods, and this is looking good. We were getting a little concerned as we were dropping below the blue line and the green line. Well, we're starting to go back above, and both of those lines are starting to turn up. This suggests that for right now, the short-term trend continues to look pretty solid. Then we look at the intermediate term trend. This is a double and triple exponential moving average based on 50 periods. We're above the red line and the blue line, and the red line goes faster. So that means there's more conviction behind this move. So this is still looking more solid for the intermediate term. We want to keep an eye on the 20 period simple and exponential moving averages. We're well above them. And so that's looking positive, and both of the lines are going up. If we start to see a decline, this usually is around the first area of support that we will come down to. And that, if we do come down, that'll put the short-term trend more in jeopardy. As long as we stay above this, the short-term trend is intact. Then here's a bunch of different moving averages, and we're above all these lines, and all the lines are going up. So short, intermediate, and long-term, we are still looking positive on a trending basis. Momentum's kind of shifting a little bit here. We were starting to turn more negative with our short-term oscillators, but now with Friday's up move, and we had a pretty good week last week. We were up over 1%. We're starting to turn up in the short term with the slope and the TSI, turning back up with the MACD, the PMO, and the PPO. These three middle indicators, they are intermediate term. We're still coming down and not really turning back positive yet with the TRIX and KST. These are two longer term oscillators. We're still hanging in there when we look at the cumulative NYSE advanced decline line. We're above this moving average. The regular NYSE advanced decline line is also going up and above the moving average. That's still looking solid for the time being. This other NYSE advanced decline line, which is calculated in a slightly different way, it's also looking positive. When we look at common stock based on price in the advanced decline line, we're just kind of chopping sideways here. We're actually looking a little bit more positive when we look at the advanced decline line based on volume for the NYSE. Then we look at the S&P 500 cumulative advanced decline line based on price, not really showing us all that much strength. Where we're seeing more strength is based on volume. So this could end up being positive for the S&P. Then we look at the new highs, new lows in the middle area here. This is just a raw score. And then over top of that, I have a 50-period moving average. That's what's plotted down below. We are getting back above zero here. This was starting to look a little weaker recently, but we're bouncing back up. We're still going down with the 50-period moving average. It would turn more positive if we could turn and go up with that moving average. Then this is a weekly chart of the S&P 500, and this is quite positive longer term. For 3 weeks now, we have closed above this R2 level, and we've been able to stay above that for the time being. These can be pretty critical. We bumped right into one of these right at the end of 2021. We also bumped into this about a year ago when we hit the high last July in 2023. We're wondering if something like that's going to happen again this July or August. But for right now, this is really looking quite positive longer term. We look at staples, which is more defensive. Think of toilet paper and toothpaste versus tech. These are the buy low, sell high growth stocks. And when this ratio is going down, that's more positive for the tech sector. That means staples are underperforming. And then we look at the S&P to utilities. When the S&P is outperforming, this ratio goes up, and that continues to look more positive. Here's another look at staples to the S&P. where this ratio is going down, and that's positive for the S&P 500. The parabolic SER, we actually went negative for a couple of days earlier in the week. We saw the dots on top, but then with the nice big up move, we ended up seeing the dots underneath. We're also looking positive with the weekly chart of the parabolic SAR. This is positive but disappointing. This is the bullish percent index. This measures the point and figure buy or sell signals inside of the S&P. We're hitting all-time highs, and this is actually declining and not really showing any strength. It just means there's a smaller number of stocks that are really controlling the S&P right now. We want to see this turn and go up. So even though it's above 50 and we have a positive stance, we're leaning more negative right now because there's really no strength that we're seeing here. Then this is the vortex, where the green line is above the red line. That's positive, and we're starting to go back up, and the red line's going down. This is more positive. And then the NYSE McClellan oscillator, when we're above zero, that's positive, even though we declined on Friday. And then from the McClellan oscillator is where we get the summation index for the NYSE. It might be hard to see, but we're just barely starting to turn up based on price and just a little tick higher here based on volume. Large cap growth, that's really what's leading the market higher, and we're setting all-time highs here with this ETF. The large caps are really outperforming the small caps, setting a new all-time high with this ratio. The NASDAQ, and this is not only setting an all-time high, but we closed above this R1 level. The NASDAQ, you can see these other pivot points. We came right up, and that acted as overhead resistance. We were finally able to break above that and close above this R1 level. So that's positive. The next question is, can we stay above this level? And we're seeing that same thing here with the NASDAQ 100. We did get above this pivot point earlier, but then fell back below. We closed above this R1 level for July, and that is positive. But we have to ask, will this continue? Or will we keep being able to go higher here? Or are we going to drop below that R1 pivot point? This is still positive. The NASDAQ 100 bullish percent index is above 50, even though it's not showing an awful lot of strength. Even in the NASDAQ 100, it's just a small group of stocks that are really controlling the index right now. But the momentum had switched over to negative. We dropped below the moving average as measured by the PPO. We're crossing back above the moving average now, so that's turning back to positive. And then we look at the S&P 500, which is a weighted index, and compare it with the equal weight S&P 500. And this is coming back, and we're really breaking out with this ratio right now. Now, you could say that's positive because all you might care about is I want the S&P 500 to go up, but it's not showing that there's really a lot of internal strength inside of the S&P 500 right now. So this might be getting a little overdone. And we look at the Wilshire 5000, a broad market measure, setting an all-time high. The total U.S. stock ETF also setting a new all-time high. The FANG index is setting an all-time high. The SOX, which is a huge part of the tech sector, not back to an all-time high yet. We saw some profit taking, and then we went sideways. Now we're starting to go back up, and we're looking at a pretty solid uptrend. We're well above the 50-day moving average, and the 50-day moving average is above the 200-day moving average. Down below, we're seeing the relative strength ratio. That's the red line, and that's actually trailing off a bit when you compare it to the S&P. And the momentum is starting to turn back up after it had been declining when we compare the momentum to the S&P. Tech sector. This is the favorite sector by a lot of folks right now, setting all-time highs by itself. Seeing a little bit of a drop-off with the relative strength as well as momentum when we compare it to the S&P. What really helped stocks this past week is a decline with the 10-year yield. And as this keeps going down, that will continue to be positive. If it goes up, that's likely to be more negative. We look at the tech sector and compare it with 3 to 7 year bonds. We are actually down a little bit on Friday, but we're well above the rainbow. And we look at another ratio between the S&P and 3 to 7 year bonds. When this is going up, that means the market is anticipating a soft landing, meaning that we won't necessarily go into a recession. This is an inverse of that chart that we just looked at. When this is going down, that means bonds are underperforming stocks. We want to see this continue to go down if we're positive on the S&P. Longer term, with the NASDAQ 100 weekly chart, we're well above this trend line going back to 2009. Then we look at a ratio between the NASDAQ 100 and the Dow. And I got this idea from a perma bear who thought, okay, we hit this back in 2000 and then everything fell apart. We hit this back in 2021, and then we had a bear market in 2022. and they were just convinced that this was the holy grail, that the market was going to fall apart. Well, now we're breaking above this when setting new highs with this ratio. So, and I haven't seen any new videos by the person that first turned me on to this idea. So I'm not sure what they're thinking about things. We're seeing a similar thing here with the QQQs, which is the NASDAQ 100 to the small caps, continuing to break out above this previous high that was set in the ratio. Semiconductors to the Dow also holding up and outperforming. And then we look at the QQQs and look at 3 to 7 year bonds and do a ratio. The Qs are solidly outperforming the price of bonds. The S&P 1500, a broad market measure with shorter term bonds, shows that stocks are outperforming. A broad market measure with 3 to 7 year bonds shows that stocks are outperforming. Now we switch over and look at the negative side. We have a thing called the Swenlin trading oscillator. Now, you could take a positive stance with this, because if you look at this based on volume, we're above zero and going up. But if you look at this based on price, we're still below zero and not really showing an awful lot of strength. This is why I stuck it on the negative side. We want to see both of these cross back above zero and be above zero at the same time. That would give us more of a confirmation. And then here we are setting all-time highs with the S&P, but yet we're declining with the 20, 50, and 200 period moving average. Not really confidence building now. Then the S&P McClellan oscillator. You remember the NYSE McClellan oscillator still positive? Well, the S&P McClellan oscillator is negative. We are below zero, and that is a negative divergence that we're seeing. So when we look at the summation index based on price, we're continuing to decline, and that's negative. Now, look at this based on volume, a completely different indicator. It is starting to turn up and actually go positive here. That could give us a little bit of a clue as to what the S&P may do based on price. Usually when volume leads price, that can be positive, but beware. We have had signals from this indicator before that ended up being false signals. Then we look at the stocks inside the S&P that are above their 20 period moving average. We're setting all-time highs with the S&P, and we're below 50 with the 20 period moving average study. That's a negative divergence. We're also going down with our 20 period study, waiting to see if that's going to improve. We're below 50 with those stocks above their 50-day simple moving average. That's a negative divergence. Crossing below 50 with the 100 period moving average study, another negative divergence, and actually declining, but still positive, because this is the 200-day simple moving average. Then we're seeing a bit of a negative divergence here, where the S&P is going up. That's the bar chart, where the NYSE advanced decline line has been going down. We want to see them both going up. And when the market really gets strong, we want to see this red line above the bar chart, even though they're on different scales. This is looking better, but still negative. When we look at the Amex, NASDAQ, and NYSE and take a 5-period moving average of the highs minus the lows, we're at minus 25 here. So we are negative, but we have been showing some improvement. Takes a little longer since this is broader based and it's spread out over 5 periods for this to actually move. We look at the NYSE bullish percent index. We're just barely dropping below 50. We're at 49.89 right now. That's negative for the time being. And when we look at the advanced decline line studies, we're below the moving average with NYSE common stock. We're right on the moving average with the S&P, below the moving average and declining with the mid caps and the small caps. Now, there's a positive sign and a negative sign here. When we look at the QQQ equal weight, we are now finally breaking out and setting a new all-time high. That's the positive side. The negative side is we're just floundering sideways when we look at the S&P 500 equal weight index. We want to see this break out and both of these confirming each other. And we look at 1 to 3 month T-bills, which you could pretty much consider cash, compare it with 3 to 7 year bonds. When this is going up, that means there's a lot of uncertainty about interest rates and inflation. This is chopping around right now, but it's still in an uptrend. Now we are declining. To turn this more positive, we want to see this continue to go down and eventually get to the point where we see a death cross with this ratio. We're seeing a very similar thing here with 1 to 3 year bonds and comparing it with 3 to 7 year bonds. We're coming to the underside of the rainbow, but you see how mismatched this looks like spaghetti in here. We want to see this continue to go down to be more positive. And we look at TIPS, which are Treasury inflation protected securities. When people are concerned about inflation and interest rates, they get into TIPS and they outperform. When this is going down, that means that the 7 to 10-year bond is outperforming. Well, we've been chopping around a little bit here. We're still in an uptrend showing that the tips are outperforming on a trending basis. We want to see this ratio go down and eventually see a death cross with this particular ratio. This is also a concern, and we're kind of getting to a decision point here. Looking at home construction compared to 3 to 7-year bonds had been holding up quite well. Now we're really starting to fall off. We're getting down to this 250 period moving average. That held before when we hit this back in October and we bounced up off of that. Is this going to hold this time, or are we going to fall through that? So we'll be keeping an eye on this one. And the Eurozone, they're having some issues with the French elections. And then the UK just had an election, and that's producing some uncertainty. And so when we compare what's happening in Europe with American bonds, we were falling back into the rainbow, but now we're starting to see this bounce back up a bit. Now, there's positive things on this chart, and this is kind of, it'll mess with your brain a little bit. The S&P going up and setting an all-time high, that's easy to figure out. There's a chart that I showed that shows the spread between risky and not as risky bonds. And then on this chart, I take that same chart, shorten down the time frame, and I invert it. And this is causing us a little bit of concern. When this is going up, that means the bond market's not having a lot of fear right now. This is starting to come down. Now, it's not falling off a cliff by any imagination, but we just want to watch this. Now, we fell down before only to start to bounce back up. We just want to keep an eye on this. And then down below is an inverted version of the VIX. This is showing, this is very high, which means the VIX is very low right now, not showing that there's much fear. So the reason I created this chart, it was actually developed by David Keller from stockcharts.com. I just wanted it to line up. When the S&P is going up, we typically want to see this going up as well as the VIX going up on this particular chart. We keep an eye on the staple sector, and when you look at it by itself, it's in a pretty solid uptrend. It's above its 50-day moving average, and the trend is positive. Kind of neutral right now when we look at the momentum, and we're actually slightly negative when we do the relative strength compared to the S&P. So this looks positive when you look only at this chart. Where it's underperforming is when we compare it to the S&P. Now, why are we even watching staples right now? It's a defensive area. And when the market is getting ready to be more defensive, they start jumping into staples type stocks, toilet paper and toothpaste. And so this can be an early warning sign to us if the market is switching over to a more defensive stance. Now, the fact that this is in an uptrend, yeah, we've been watching this for quite a while now. So that is a concern in and of itself. But on a relative basis, if we start to see this ratio going back up, maybe not even turning positive, but really starting to show some strength here, that's going to throw up even more warning signs for us. We do the same thing here with utilities. Now, you could make a couple of different cases for why utilities have been going up. We've got all the Bitcoin and crypto mining that goes on out there. We've got AI and all the electricity that's going to be needed for that. And so that can be a reason why utilities are going up. But this is also a defensive area of the market. This is what folks get into when they're worried about a market decline. And this has been in a solid uptrend, and it came back down, and it's actually dropping a bit below its 50-day moving average, even though it's still in an uptrend. When we look at the relative strength compared to the S&P, it's ticking back up, but it's negative, and we're showing a little bit of an improvement with the momentum compared to the S&P. But then when we break this out and do a ratio between utilities and the S&P, we had been showing a real improvement here, but then that fell apart. We still saw a golden cross with this ratio, but now we're dropping back down below both lines. So this is just something that we're watching day by day for the time being. Then we look at the US dollar index, which is still in an uptrend, and an advancing dollar tends to pressure stocks. We came down and closed back into the mid 104 range, and that's giving support to stocks. Thank you. I really hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.